Hello world, welcome to Farm the Market. What are options and how they work? In this video, I will cover the basic characteristics of call and put options and how they work. If you are new to the subject, I recommend that you check out my Options Basics playlist in chronological order. As we discussed in a previous video, an option is a derivative. In essence, an option is a type of financial contract between two parties that confers rights and obligations depending which side you are on, buyer or seller. Where can you buy and sell these contracts? As with many derivatives, options trade in two types of markets, OTC and listed. OTC stands for over-the-counter. This market is typically reserved only for big players, like financial entities, institutional investors, companies, and governments. It is usually used when the listed contracts do not meet their needs. Some of the advantages are that option contract characteristics can be tailored fit. These are usually referred to as exotic options, given their unique characteristics and sometimes atypical payoff profiles. Some of the disadvantages are that there is none or an extremely limited secondary market and a higher counterparty risk. Even though these trades are made directly between two parties, no exchange needed, they still must adhere to a legal framework, for example, an ISDA master agreement, and comply with financial regulations, like FINRA in the USA. The listed or exchange-traded market is where standardized options contracts are bought and sold. These exchanges can be accessed by all types of investors using a brokerage firm. In the case of options, given the inherent risks, some restrictions may apply depending on the type of investor. But to be honest, nowadays pretty much anyone with two thumbs and an internet connection can trade options. Although standardized contracts might sound limited if we compare them with OTC options, the reality is that the variety available in terms of underlying, expiration dates, and strikes will pretty much cover the needs of any trader or investor. Expiration cycles used to be every 3 months, but now the most liquid underlying have weekly expirations, and for some indices there are even 3 expirations per week, on Mondays, Wednesdays, and Fridays. The listed options also have one of the most important characteristics for investors, and especially for traders, a deep and efficient secondary market, unlike OTC options. Although it's interesting to know about the existence of the OTC market, for practical purposes, I will just focus on exchange-traded stock options from now on. Let us dive into the two main types of option contracts. What is a call option? A call option is a financial contract that gives the buyer the right, no obligation, to buy an underlying asset at a specified price during a certain period. In exchange for this right, the option buyer pays a premium. The call seller has the obligation to sell the underlying asset at the specified price during the period if the option buyer decides to exercise his right. In exchange for this obligation, the option seller receives a premium. What is a put option? A put option is a financial contract that gives the buyer the right, no obligation, to sell an underlying asset at a specified price during a certain period. In exchange for this right, the option buyer pays a premium. The put seller has the obligation to buy the underlying asset at a specified price during the period if the option buyer decides to exercise his right. In exchange for this obligation, the option seller receives a premium. As you can see, the definitions are practically identical. You just have to exchange the words buy and sell. Call equals buy and put equals sell. Now, let us review the characteristics of an option. All figures are hypothetical. The underlying. It is the asset that the option derives its value from. Remember, an option is a derivative. The assets are usually of financial nature, like a stock, index, commodity, currency, or a bond. But if you want to get fancy, there are examples of options where the weather is the underlying. For our purposes, we will stick mainly to stocks as the underlying. The strike price. It is the specified price in the option contract. The price is fixed and cannot be changed. It's commonly just called the strike and is abbreviated with the letter K. Contract size. As I mentioned before, we will focus on listed stock options. Therefore, the norm is that each option contract represents 100 shares of the underlying. This is especially important. We always must be aware of the actual notional amount we are exposed to. For example, let's compare 10 call options for Tesla with a strike of $800 and 10 call options for US Steel with a strike of $15. In both cases, we are only talking about 10 contracts per underlying, but in terms of the notional amount, there is a big difference. To calculate the notional amount, we just multiply the strike times the number of contracts times 100 shares per contract, and that equals the notional amount. For Tesla, it will be $800 times 10 times 100, and that equals $800,000. And for US Steel, it would be $15 times 10 times 100 equals $15,000. In both cases, we are talking about 10 options contracts. But in terms of the notional value, the difference is huge, almost 53 times. The spot price. It refers to the current market price of the underlying. This price is dynamic and it's constantly changing. It's commonly just called the spot and abbreviated with the letter S. Period. Unlike stocks, options have a defined lifespan. They have an expiration date. The period is defined as the number of days until expiration. Since we are talking about standardized contracts, you might not find an option with the exact number of days until expiration you want. However, you can choose the closest expiration available, and the period will be equal to the expiration date minus the trade date. Premium. It is the market value of the option. It is the amount paid by the option buyer and received by the option seller. The premium is paid the moment the option is traded. The premium of an option has two components, intrinsic value and extrinsic value. To be more precise, premium equals intrinsic value plus extrinsic value. Intrinsic value. It's one of the components of the premium. It has to be greater than or equal to 0. It cannot be a negative value. Its calculation depends on the type of option. For calls, it will be the maximum value between 0 and the spot price minus the strike price. For puts, it will be the maximum value between 0 and the strike price minus the spot price. The easiest way to understand intrinsic value is to put yourself in the shoes of the option buyer. As a buyer, you only have rights, no obligations. Therefore, you only act if the market is in your favor. In the case of a call option, that means you would only use your option if the spot price were greater than the strike price. You would be buying the stock below the current market value. That would mean the calculation S minus K is positive. There is intrinsic value. For a put option, you would only use your option if the spot price were lower than the strike price. You would be selling the stock above the current market value. That would mean the calculation K minus S is positive. There is intrinsic value. Let's look at an example. We assume that the market has closed on expiration day. For the calls, let's look at the strike column first. If I bought a call option, I have the right to buy the underlying at the strike. I would only use my option if the spot were above the strike. In other words, if there is intrinsic value. As we can see in this table, the intrinsic value will always be equal to the maximum between 0 and the spot minus the strike. Therefore, whenever we have a spot higher than the strike, we have intrinsic value. For the puts, again, let's look at the strike column first. If I bought a put option, I have the right to sell the underlying at the strike. I would only use my option if the spot were below the strike, in other words, if there is intrinsic value. As a side note, we assumed that the market had already closed on expiration day, so we can ignore the extrinsic value. It will be 0 at this point. Extrinsic value. It's the second component of the premium. It has to be greater than or equal to 0. In its simplest form, the extrinsic value is equal to the premium minus the intrinsic value. Let's revisit our example, but this time we assume we are at a random date before expiration, so there is some extrinsic value present. Now we can see that regardless of the intrinsic value, since there is some time left to expiration, extrinsic value is positive, and therefore the premium is always greater than the intrinsic value. Remember, premium equals intrinsic value plus extrinsic value, and neither can be less than 0. Extrinsic value is also referred to as the time value of the option. To be more specific, extrinsic value is composed of time and implied volatility. All else being equal, if time to expiration increases and volatility increases, the extrinsic value will increase. And vice versa, if time to expiration decreases and volatility decreases, the extrinsic value will decrease. These two variables will be explained in more detail in future videos. Exercise. When the option holder decides to make use of his right. In a call option, that means buying the underlying, and for a put option, selling the underlying. To understand when is exercise possible, let's introduce two concepts. American option, type of option that can be exercised at any time before and including the expiration day. European option, type of option that can only be exercised at expiration. The names American and European have nothing to do with where the options are listed. It is not about geography. It's only about when the exercise rights are available. Most of the listed stock options are American, so for our purposes, we will always assume that we're talking about American options. As a rule of thumb, it is not a good idea to exercise an option before expiration. There are some exceptions, but in general, there's no point on giving away the extrinsic value still present in the option. It makes more sense to sell the option and simultaneously buy or sell the underlying directly. We will discuss this topic in more detail in future videos. Moneyness. This is a relationship between the strike and the spot price. It tells us if there is intrinsic value in the option. The terms used to describe moneyness are at the money, in the money, and out of the money. At the money. It means the strike is equal to the spot. This term is also loosely used when the strike is really close to the spot. In the money. It means there is intrinsic value. For calls, the strike is below the spot, and for puts, the strike is above the spot. Out of the money. It means there is no intrinsic value. For calls, the strike is above the spot, and for puts, the strike is below the spot. Let's look back to our examples, adding this new concept. As you can see, whenever there is intrinsic value present, we can say that the option is in the money, and when there is no intrinsic value present, we can say the option is out of the money. We also modified one of the examples to set the strike equal to the spot, so we can have one case where the option is at the money. Positions. Since there are two types of options, calls and puts, and you can take either side of the trade, be the buyer or the seller, there are four basic individual positions you can be in when trading options. Let's take a look at the payoff charts of these positions at expiration. Remember, at expiration there is no extrinsic value, so the profit and loss are just determined by the intrinsic value. In future videos, we will talk about the behavior of the option premium during its lifespan, and how it is affected by factors like the spot, time, and volatility. But as of right now, we will keep it simple and just focus on the payoff at expiration. I also include some of the different terms you might come across for each individual position, and the important considerations regarding profit and loss. All the figures are hypothetical, and any commissions are ignored. Buy a call, long a call, or hold a call. I divided the payoff chart in 3 sections, going from left to right. Red section. At expiration, the stock price is at or below the strike price. Therefore, there is no intrinsic value and the option expires worthless. It makes no sense to exercise this option. The result will be a loss equal to the premium paid. The option holder cannot lose more than that. Gray section. At expiration, the stock price is slightly above the strike price. There is intrinsic value, but the intrinsic value is less than the premium paid. In this section, the loss is less, but is still a loss. The point where the intrinsic value is equal to the premium paid is called the break-even point. Green section. At expiration, the stock price is above the strike price, and the intrinsic value is greater than the premium paid. In this section, the holder has a profit, and in theory is potentially unlimited. The stock cannot have an infinite value, but it can multiply in value many times over, unlike to the downside where the limit is 0. Let's keep this in mind for our next example. Sell a call, short a call, write a call, naked call. Again, I divided the payoff chart in 3 sections, going from left to right. Green section. At expiration, the stock price is below the strike price and there is no intrinsic value. The option will expire worthless, so the option writer keeps the whole premium. Gray section. At expiration, the stock price is slightly above the strike price. There is some intrinsic value, but it is less or equal to the premium. The option holder will exercise the option. The option writer makes a smaller profit or breaks even. Red section. At expiration, the stock price is above the strike price. There is intrinsic value, and it is greater than the premium received. This is losing territory for the option writer. As we discussed in the previous example, there is no limit to how high a stock can go. Being short a call is an extremely dangerous position. The profit is limited, and the loss can be exceptionally large, many times over the notional amount. As a rule of thumb, never be short a call as an individual position. Buy a put, long a put, hold a put. Going from right to left. Red section. At expiration, the stock price is at or above the strike price. Therefore, there is no intrinsic value and the option expires worthless. It makes no sense to exercise. The result will be a loss equal to the premium paid. The option holder cannot lose more than that. Gray section. At expiration, the stock price is slightly below the strike price. There is intrinsic value, but the intrinsic value is less than the premium paid. In this section, the loss is less, but there is still a loss. The point where the intrinsic value is equal to the premium paid is called the break-even point. Green section. At expiration, the stock price is below the strike price. There is intrinsic value, and it is greater than the premium paid. In this section, the holder has a profit. The price of a stock only goes as low as 0, therefore that would be the limit of the potential profit. Sell a put, short a put, write a put, naked put. Going from right to left. Green section. At expiration, the stock price is above the strike price and there is no intrinsic value. The option will expire worthless, so the option writer keeps the whole premium. Gray section. At expiration, the stock price is slightly below the strike price. There is some intrinsic value, but it is less or equal to the premium. The option holder will exercise the option. The option writer makes a smaller profit or breaks even. Red section. At expiration, the stock price is below the strike price. There is intrinsic value, and it is greater than the premium received. This is losing territory for the option writer. Although not as risky as a naked call, being short a put option is also a risky position. That was a lot of information, but it is important to comprehend what each concept means, since they are part of the options world and you will come across them often. Calls and puts are the building blocks for all the options strategies out there, so getting the basics right is very important. Feel free to watch again as many times as you need. There you have it, a basic introduction to what options are and how they work. This is just the tip of the iceberg. In future videos, we will go deeper into the options world. I hope you found this information useful and interesting. Remember that everything presented here is for educational purposes only. If you liked the content, please don't forget to like this video. If you haven't already, I invite you to subscribe to the channel and turn on notifications so you don't miss future videos. Thanks for your time.